welcome back to the Real Estate 401k show. I'm your host, Mike Weinstein, alongside Justin Frederick and Ryan Gerdes, all the way down at the end of the table. Hey. You're going to want to text the word loan to 623-AZ-RECON. That's loan to 623-AZ-RECON. I think I don't have to read it during this episode, so I'm going to take off my glasses just so that people...
there you are.
You can't read with them on anyways.
That might be the funniest thing I've ever heard come out of your mouth, dude.
So I'm going to blow you up right now, dude. You know how we were blowing up Amy on the webinar yesterday? Do you know that every single one of your slides on Wednesday had not only a misspelling but grammar errors on every single slide?
Okay. Was I aware of it? No. Do I assume? Yes.
And I'm not even a grammar Nazi, and I looked at it and I was like, oh, shit.
It all depends on what time of the day and whether I'm drinking cocktails or not.
Yeah. Apparently, the short word of motivation is motifs. You wrote motifs.
Yeah, that makes sense.
Made sense to Mike.
You say motive, I say motif. Tomato, tomato. I have never claimed, and it's so funny because you guys know, my wife's a published author, big deal. She's made her whole living writing content, and she sent me this text the other day that had like bad grammar, and I hit her up on that. And I'm like, hey, darling, what bad grammar here?
Yeah.
Where's the punctuation? Interesting. Do you know where we? Okay, so we are so
way
digressing, way off topic. And I don't know where I picked this little piece of information up. Probably a Joe Rogan podcast, right? Mm-hmm. And so we're getting into the discussion about how our kids don't know how to communicate and spell anymore because of the way that we text and the lingo and so forth. But where it came from BlackBerries because of all the different, and the old flip phones, all the different buttons that you would have to hit.
What was that, 4T or something?
Yeah, but just to get to the right letter. So that's when we started shortening words via text.
Huh.
Makes sense.
Well, I think that we still probably misspelled a lot of our vernacular from back in the day. Like, I'm still not 100% sure how to spell homie.
I would go with HOMEY.
HOMIE.
See? And both of them are very well accepted.
Yeah.
So for people who don't know my history, I used to be the executive vice president for West USA Realty. And after the second go-around, when Ryan said that if I didn't join him and do this partnership thing and create this juggernaut team that we have, he was going to come to my house, knock on the door, and when I opened it, he was going to kick me in the balls, right?
That's a true story.
So I submitted my letter of resignation, and the president, Clint Fouts, ended up bringing it back to me. He took a red pen. I misspelled his name, his last name.
Bold move, Cotton.
Anyway, so text the word loan, not grammar, but text the word loan, LOAN.
You can spell it any way that you want. We'll understand.
623-AZ-RECON. Anyways, Justin, we'll toot your horn a little bit today. And I say it all the time, not all loan officers and lenders and mortgage companies are the same. There is so much that goes into it. If every deal was easy and never had a hiccup, it wouldn't matter who the loan officer was, and it wouldn't matter who the agent is. Unfortunately, there's no such thing as a 100% smooth loan and a 100% smooth transaction. There's always issues. One of the reasons there's two reasons why I don't like big box banks or just online, loan.com and so forth. Number one, they don't have the same hours that we do. Mm-hmm. They're 9 to 5, Monday through Friday. We're writing contracts and we're having issues, Saturdays, Sundays, and evenings. And then number two, they just don't have the creativity. They don't have access to the multitudes and the myriads of loan programs that are out there that can help a buyer get to the finish line. So you and I were talking earlier this week, and or last week, and I said, so what are some of the loan programs that our listeners need to know about that a lot of people don't know about them, including a lot of loan officers? So what's your favorite one?
Oh, my favorite one right now.
What's the flavor of the month?
Right now is the short-term cash out. And I think we talked about it in an episode last week. We barely touched point on it, but there's a lot of individuals out there that have their current home paid off. They're looking to downsize or buy another property, and they're wanting to bridge the equity from their current home into the new home, and they don't want to sell home A first in order to acquire home B. The biggest, what we were using for the longest period of time were bridge loans. They would bridge the gap. They would lend the money on home A to put the down payment on home B.
And then you could sell home A afterwards.
Correct. But you had to have a mortgage on home B, and they would only give you a certain percentage. Plus, you paid the fee, the convenience fee for using this product on the entire sale price of home A. So it was expensive.
Not the loan amount, just the entire sales price.
Correct. The entire sales price. So you were getting hit hard for the amount that you were financing on home B. This short-term cash out program, typically we won't lend on a property that's listed for sale or is intended on being listed for sale. But this product will allow us to do that. It will allow us to...
Designed to do that.
It's designed to do that. It doesn't have early payoff penalties or prepayment penalties. So you can take out money on home A and just pay on the money that you're borrowing, not on the sales price, and take those funds and apply it towards home B and not have a mortgage on home B. So it's beautiful. It's a beautiful product. And then once you sell home A, your home B is already free and clear. You're just paying off the lien that you needed to pay off home B on home A, and you're good. It makes sense, and I just don't understand why it took us so long to develop a product like this. Plus, the investor's making money on the money that you're borrowing, so it's a win-win all the way around.
So, can I pay this off? Like let's say I want to move, right? Mm-hmm. So I do the acquisition of home 2 or home B, right? And then I'm doing some restoration on home A to get it ready to sell, and I fall back in love with it.
Okay.
And in the meantime, I borrowed $500,000 from you guys to acquire home B. But so maybe I'll just use that as a rental property now, and then pay you the $500,000 back. Is that possible, or how does that deal? Because like the acquisition cost of the loan is, let's say that this first home was worth $400,000. Would I just pay you $4,000 of like an appraised value of it, or how would that work? Or like how could that be reconciled?
So you're going to want to refinance home A at that point, and the reason why is because the lien on home A for the short-term cash out is holding a lien on both A and B properties. Okay. They're doing that to make sure that they get paid. Okay. Because if you sold home A and for some reason they didn't get paid, they still have a lien on home B. But you would just refinance home A into a standard conventional loan. So you would have more costs if you decided to do that. But I feel like that's going to be coming up.
Not the rule. Yeah, but I love the concept. I love the design of it. I think there's a lot of people that could benefit from it.
Yeah, a lot of our peeps.
Yeah, we have a situation right now where we have an older gal, and she's like many folks, myself even. I don't like a whole lot of change, and so having random people come into my home, disrupting our life and whatnot, is not ideal. So she needs to buy something before she can let people view her home. Plus, she has 30 years worth of stuff, right? So where's that going to live? But she owns it free and clear, and this is going to be a perfect vehicle for her to make that transition. So I love it.
So what was the name of that?
Short-term cash out.
All right. If you'd like some more information from Justin and his team, all you got to do is text the word loan to 623-AZ-RECON. That's loan to 623-AZ-RECON. Last week you talked about one. I love this one because Ryan and I, we preach home equity lines of credits. Before you move, get a home equity line of credit on your home because it works like a credit card. You pay an annual fee. You don't pay anything unless you use it. The downside to it, it's an adjustable rate. So right now with mortgage rates high, your interest rate on your HELOC's high. But if you're in a position where you know you need X amount of dollars from home A to do whatever it is that you want to do, whether it's put in a pool or whatever the case is, you got another great product.
It's called a closed-end second, and what a closed-end second means is it's the amount of money that you're taking out. You're just getting it in a lump sum at closing, and it's fully amortized. So you're going to pay a fixed monthly payment. The interest rate's fixed on it. You can get a 10-year interest-only period on a 30-year loan or a 20-year loan if you'd like, to keep your liabilities low. But it's giving lower fixed interest payments on that money. And people are searching for that right now because a lot of these home equity lines of credit, you're starting to see those because a lot of people have been taking advantage of the home equity lines of credit. You're seeing interest rates anywhere from 8.5% all the way up to 15, 16% on these lines of credit, where if you have a lower FICO score and you're looking to obtain a good amount of money, but you have a lot of equity, if you have a 640 credit score, I can put you in a closed-end second for probably somewhere around 8.5%, which is unheard of.
For a higher risk loan, that's ridiculously low.
Right. Well, and this is considered less risk than a home equity line of credit.
Kind of, it's higher risk than a purchase.
100%. It's a higher risk than a first mortgage for sure. But
so perfect if you know you're getting a divorce. I'm taking the money and running.
Well,
baby.
if you're listening to Mike Weinstein, there's a good chance you might go through a divorce in the near future.
And I know how to spell the word divorce.
You know, a lot of the people who are taking advantage of this product is remodeling the home or putting in pools. Just because they know they're taking out a large lump sum, they're not comfortable with that large lump sum being on a variable rate. They'd really like to have that payment fixed. This is a perfect product for someone.
Well, I need you to send a message to Mindy saying, hey, we got this product. Finally, we can get Mike that fishing boat that he wants.
I'm sure that's what it's designed
I'm sure
for.
that's what it's designed for.
All right. It's a fantastic alternative, depending on what your needs are, but a fantastic alternative to a home equity line of credit or what we like to refer to as a HELOC. If you'd like some more information about any of these loan programs, we want to put you in touch with Justin and his team. All you got to do is text the word loan to 623-AZ-RECON. That's loan to 623-AZ-RECON. All right, one more.
So I'm gonna go with our second mortgage products because there's just nothing, or excuse me, not our second mortgage, our second home products, because there's just nothing that competes with us in these on these second homes. If you're buying a second home with 20% down, the rates are phenomenal on these products compared to a standard conventional loan. And we basically have portfolio jumbo products. That's what they're considered as jumbo products. That will allow us to go down to a loan amount of $100,000, but they're considered a jumbo product because it is a portfolio loan.
Give me an idea of like how drastic is the difference if I get a mortgage for a second home, the interest rate of putting 10% down versus 20% down, because you mentioned 20% is that sweet spot.
You're probably looking at a difference of about 1.25% on the rate. You're probably looking at a difference of about 2 points as well, 1.5 to 2 points. So significant reduction. And the only reason why
2 points in buy
cost,
down.
in cost, yeah.
Okay.
If you're doing 10% down on a second home right now, you're probably you need to expect somewhere around 2.5 to 3 points for that buy down on the rate. But
so you may as well just come up with the other 7%.
I mean,
Yeah,
you're going to save yourself.
That's a great way of looking at it. So it's not an extra 10%.
Yeah.
You talk about an extra 7%. Yeah, that's a good point.
And then you're putting the money in your pocket.
You're putting the money in your asset.
Right, rather than into the bank's
Cost.
pocket.
Right.
Yeah.
And the only reason why we're at it's a 20 because the investor our owner requires 20% down to use this product. Now that may change in the future, but for right now it's 20%. We're just not seeing anybody match our numbers when it comes to this. Not even close.
And Ryan, I know we've talked about it on past episodes, but a second home is a great investment tool because it's not just a second home that I'm going to go use 2 weeks out of the year. I mean, now you're going to get a phenomenal rate. You're going to have a place to vacation, but then you can turn it into some sort of income-producing property as well.
Well, and our total motive, I mean, you've heard us talk about our place up in Alaska. And so while it's nice using it as a vacation home while we're before we retire, our ultimate goal is to retire up there. And so I'm thinking about what the obvious is. We all know that the values of real estate go up, and it's going to be a long time before I'm ever going to say I'm truly retiring, right? And so I'm over here thinking, for most people that are in their 40s, and if they're working and if they're going to stay at their same place of business until they're 65 or whatever their number is, that's still a solid 20 years. You're going to see massive growth. And then you're also going to have 20 years worth of opportunities of taking advantage of whatever happens to the market on the interest rate side. So, like, case in point, my interest rate on our property up there is at 5%. I think it's a pretty darn good one.
It's a great one.
It's a great one.
Yeah. But let's just say miraculously rates drop down to 4% in 10 years. I have no problem going over there and doing a straight refinance on it and then benefiting off of that. So where most people, they're waiting until they're 65. If you wait until you're 65 to buy your retirement home, you are 100% at the mercy of the market. If you play it the way that we're playing it, you have 20 years to not only take advantage of whatever the market may have to offer, you get to make some money and have an awesome vacation home in the interim. So there's just the benefits just go on and it creates so much flexibility. But more importantly, for that specific property, it's creating a ton of memories for us.
Well, this might be an opportune time to talk about our network because people might be listening. That sounds great. Mike, Ryan, and Justin love what you guys do, and I love those strategies. But I'm not necessarily looking at a second home in the state of Arizona. I'm looking in Nebraska or Alaska, whatever the case is. Our network of real estate professionals and loan officers, and Justin, you're licensed all over the country, that are like-minded and can have these same type of conversations with you are endless. So
yeah, you wrote our loan up there in Alaska.
I did. Yeah.
So.
All right. Well, Justin, with the Frederick team at Fairway Independent Mortgage, we've just highlighted 3 loan products that you may not be as familiar with, but he's got a ton more. This is, again, why I'm not a big fan of big box banks for my mortgages or, online outfits, because there's so many programs out there. You have to have access to them. We encourage you to text the word loan to 623-AZ-RECON. We want to put you in touch with Justin and his team. Again, text the word loan to 623-AZ-RECON.